Hello, welcome to another brief 5-minute tax update for the clients of CCM. My name is Rob Neiman. I am the tax director of CCM, and today I'm going to give a little talk about the good and bad of buying a company car through your limited company. Now, this is a question we get an awful lot at CCM. Should I buy a company car through my limited company? And I'm going to sneak preview the ending. No. Buying a company car seems like a great idea. It's one of those things where you think there can be loads of tax benefits available to you. In truth, there probably isn't. And indeed, it's probably going to cost you considerably more than you will save on the company side of the tax. So running down a few of the ideas that people usually come at. Can I reclaim the VAT on the car? And therefore, it costs me at least 20% less. Chances are you can't. If there's any private elements usage of the car, and that includes traveling backwards and forwards from home to your place of work, you're not going to be able to claim the VAT. Indeed, in the last 25 years of being in accountancy, I have only seen a car VAT be reclaimable once under massively extreme conditions, and that could make a whole video in itself how the guy managed to actually do it. Needless to say, you don't want to go there. The next thing that people normally think about is, can I get any form of tax-free cash by doing this? Well, no, because if the company buys your car for you and you're driving around with it in private use, you're going to have a benefit in kind. This is a tax bill that's going to arise because you are using an asset of a business that's not directly yours. It also means you're going to have to be preparing P11Ds, which is an extra tax return, which, while good for us at CCM because we get to raise an extra bill for you, is not going to be good for you because you have got an extra cost as well as an extra tax liability. If you do decide to go down the car route, you've also then got to give rise to the potential capital allowances that the company can claim. This is a tax relief against that P11D charge that I mentioned before. The capital allowances are going to be reclaimed and charged based on the CO2 emissions of the car, which brings us neatly to the one caveat. If you are thinking of buying an electric car, or one of the hybrids, you might be in for some luck and be able to get this through your limited company without costing you significantly. The hybrids are an evolving thing. This year they're pretty good. That's tax year 2021. Tax year 21-22, less good. And by 22-23, you're probably going to have a tax bill again, as in the same way that you will have with anything. The electric cars, Teslas being the most obvious example to me, is slightly different in that you're going to be able to get a 100% initial first year allowance in your limited company, giving you a tax write-off, and have no benefit in kind on it. Now, the only thing is, do you actually want to drive a Tesla? It's a moot choice. Some people do, some people don't. I personally don't think they're there yet, and I sure as hell don't want to be paying £85,000 for one. The other thing that people never take into account when looking at company cars is the fuel on these. If you are going to buy a company car and fill it up with petrol and charge, or diesel, and charge that petrol or diesel back to your company, you are going to get another benefit in kind, which means you're going to have to do another P11D box within it. Again, there's more of a charge for CCM in that, which is always good news, but you are then facing another tax liability. All in all, this can be quite an expensive process depending on how much fuel you're actually going to put in it. Ironically, again, like the exception with electric cars, I will give a shout out to extremely expensive cars. If you're thinking of buying a Lamborghini, funny thing is, it might actually be worth paying the benefit in kind and the fuel charge on it if you actually look at the amount of money you have to get out of your company. But that is a specific calculation we would have to do for you in the event that you're considering buying a supercar. If you are, you know what to do. Contact me via the website, make a booked call, on my direct calendar, and I'm happy to chat this through with you. But please do be aware, when people ask us to actually undertake specific individual calculations to their circumstances, we do look to make a charge because that is actual specific work. Other alternatives, as I've mentioned before, is electric, or the easiest route to go. And this is why I started the whole thing with a heads up of don't buy it into your company, do it this way instead. Buy the car, whatever is the cheapest finance route for you. Put it in your own personal name. So if you want to lease it, lease it. If you want to buy it outright, buy it outright. If you want to HP it, HP it. But then keep a track of your business mileage. Business mileage is those miles that you do wholly and exclusively for the purposes of your trade or profession. If you keep those down by either writing them, if you're old-fashioned like me, in a notebook, or if you're modern, by downloading an app onto your phone, and there's loads of free one if you go to one of the app stores, you can claim 45p a mile for the first 10,000 miles and 25p a mile thereafter. That means if you're doing 10,000 business miles a year, you've got £4,500 of tax-free cash you can get out of your limited company to run the car. You're doing 20,000 business miles a year, it's about £7,000 you can get out of your company for running your car. Most reasonable, normal cars can well be run for that type of money. So, moral of the story is, don't buy the car into your limited company. There is no special tax saving by doing so, unless you're thinking of going electric or unless you are contemplating a supercar. That's it for this time. Thank you very much for listening. My name is Rob Newman, the Tax Director of CCM. I'll see you again in the next episode.